Have you ever made a purchase before? Odds are you probably have. This means that you have purchasing power. As a consumer, you have the ability to buy products and services. When considering purchasing power, you might ask yourself how inflation impacts your spending. So how are they related? Generally, when inflation rises, purchasing power decreases. Let's take a look at an example. Let's say you have $100 and a burger meal costs $10. That means that you can buy 10 burger meals in one sitting. Now, fast forward a couple of years where inflation increases the price of the same burger meal. You're rich and still have $100 to spend on burgers, but now the price of each burger meal is $20. This time around, you can only buy 5 meals, meaning your purchasing power has dropped. You are now unable to buy the same amount of goods with a fixed amount of money. With this example in mind, you're probably asking yourself, how do you preserve your purchasing power? And how do you hedge against inflation? Well, first, we have to consider your investment portfolio. We're going to talk about 3 investment strategies that may answer these questions: safe investments, tips, and mutual funds. Let's first look at safe investments. Some examples of these investments include cash, government bonds, and certificates of deposit, or CDs. Let's look at an example with government bonds to see how inflation may impact your wealth. Consider again your newfound wealth of $100. If inflation is 3% in 2018, then after 1 year, $100 is only worth $97, resulting in a loss of $3 in real terms. However, if you invested in a 1-year bond with a 2% interest rate, then your wealth declines by the rate of inflation to $97, but the interest earned offsets this decline by $2, reducing your net purchasing power by $1 to $99. This silent killer for portfolios can seriously add up over time. As investors see their account balances increase, the real value of their wealth may be declining as costs go up. What does this mean moving forward? Ensure your portfolio isn't too heavily weighted in safe investments. Don't be too conservative, as these funds may not outpace inflation, but do consider adding these types of investments to your portfolio for diversification and stability. The takeaway? Safe investments are great during periods of low inflation. Next, we will discuss TIPS, or Treasury Inflation Protection Securities. These investments are low risk, backed by the U.S. government, and adjust in value when inflation rises, ultimately preserving your purchasing power. TIPS are great to have in your portfolio during periods of high inflation. Finally, mutual funds. Think of mutual funds as a basket of securities that hold diverse investments and are professionally managed. Mutual funds can contain anything from high-yield bonds, real return funds, real estate, oil, currencies, and more. With a mutual fund in your strategy, you can diversify your portfolio to help counteract the effects of inflation. Holistically, these 3 tips can help you better preserve your purchasing power. Interested in learning more? Visit our website at www.getyour5.com to reach your financial independence and ultimate peace of mind through education.